Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to forward contract as a cash flow hedge. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you're following along in OneNote, and you don't need to be following along in OneNote, but if you have access to it and want to, then we're going to be in the 1138 P3 section. We're in the section problem presentations. We're going to go through all of the information first, and then we'll go back through components of that information as we work through the practice problem. The first part of this information may look familiar if you've been working prior practice problems, because we're going to have similar components to it, and then we're going to have the variance, which will be changes to them, and that's where we're going to be putting our focus, putting our concentration. So on 12/1, X1, U.S. company, that's us, entered into a 120-day forward contract to purchase Australian dollars. That's 100,000 AUD, which is going to be standing for Australian dollars for us. Then we have the spot rate and the forward rates for the relevant dates, which we'll come back to at a later time. Then we have the forward contract was to hedge an anticipated purchase of furniture on 1/30/2. The purchase took place on 1/30/2 with payment due on 3/31/2, and this is a derivative designed as a cash flow hedge. So now we have a cash flow hedge that we're going to be dealing with. Company uses the forward exchange rate to measure hedge effectiveness. So now we have the cash flow hedge. Other than that, it's going to be a similar scenario. So let me recap the scenario that we have here. So we got us, we're the U.S. company. We're going to be purchasing furniture from an Australian company. So we took out a forward contract, the forward contract on 12/1, and the forward contract was to hedge an anticipated purchase of furniture. So on 12/1, we anticipated we were going to be purchasing the furniture. We took out the hedge at that point in time. Then the actual purchase took place on 1/30/2, where we had the purchase, but it was purchased on account. Therefore, we purchased the furniture, have not yet paid for the furniture on that point. Then the payment's going to take place on 3/31/2. When we pay off the furniture, we're going to be paying it off with Australian dollars. Now, in order to support that, we have the forward contract hedge. Remember, the forward contract hedge was to anticipate the purchase. So the period from 12/1, when we start the hedge, to 1/30/2, when we actually make the purchase on account, then that's going to be the primary purpose there. And then after that point in time, now we have the accounts payable in place, and the hedge and the forward contract will still be covering the payable time period from January 1st to 3/31. In other words, if we look at the full time period from December till 3/31, we got 4 months for 120 days, and that's what the contract is for. So the contract is for 12/1 X1. US entered into the forward contract for 120 days, which is going to end at the end of the time period at that 3/31/2 point. Then we got the relevant rates, the spot rates, remember, being the current rate that we're basically working with, the exchange rate at that point in time, the forward rate, then predicting to some future point in time, that future point in time being 3/31, because that's going to be the end of the contract for the forward contract. All right, so let's go down through our information. So we've got our information. We're going to have our trial balance on the right-hand side. We're going to have our journal entries on the left-hand side. We'll do this one at a time. The beginning balances will be very, very basic beginning balances, so we can focus in on the changes that we will be doing. Entries will be here. Then we'll have the ending balances. The entries will include everything that has been added up until and including the journal entry that we are currently working in on. We're going to start off with the forward contract then. So we're going to put the forward contract on the books just like we've seen in prior presentations. So remember, we haven't purchased the equipment, but we're anticipating that we're going to be purchasing the equipment. And therefore, we're going to put the forward contract on the books at this point in time. So that's going to be the 100,000 Australian dollars. And we're going to multiply that times the the forward rate, the 0.609. That's going to be the 60,900. The forward contract basically representing an asset and a liability that will be put on the books. Asset being the foreign currency receivable from the exchange broker in Australian dollars. The liability being the dollar payable to the exchange broker. Here's the debit and credit. Here is it recorded in our trial balance. Remember that the dollars payable down below is in US dollars. So that just means that within 120 days at the end of the time period, we're going to be paying the US dollars straightforward, no adjustment for timing difference for currency changes. The item up top, the foreign currency receivable, is in Australian dollars, and therefore we will be receiving 100,000 Australian dollars in the future, which we have predicted using the forward rate at that time to be that 60,900, which we're measuring then in US dollars best we can at this point in time. Next time period is going to happen is the 12/31 end of the period. So at the end of the period, then we're going to have our balance sheet date. We're going to have to update this account on the forward contract. So this account's going to be needing to be updated. To do so, let's go back up to the prior point to see where we were before. So this is what was in there before. And now we're going to make an adjustment for the 12/31 adjustment to adjust that amount to the current balance. So we're going to say, all right, now it's 100,000. We're going to be using the forward rate. We're still aiming to that point on 3/31, but now we're at a different present point in time, which is 12/31. So we're going to take that 100,000 times the 0.612. That's going to be the 61,200. Take that minus what's currently in there, the 60,900. That's going to give us a $300 difference. That $300 difference would result basically in a gain. Why? Because $1 Australian dollar was worth, we're predicting 0.609 US dollars. Now $1 Australian dollar is worth 0.612 US dollars. Australian dollar now has gotten stronger. This is a receivable, thinking we're going to receive the Australian dollars in the future, and therefore we're going to get paid in something that is stronger than it was when we originally made the contract, so we have a gain. You can also calculate that $300 by taking the difference between the two rates, 0.612 minus the 0.609, then multiplying that times the 100,000, you get that same $300. So the transaction then is going to look like this. This is where it's a little bit different. Remember that this entries column is including everything that we have done thus far in this current year, plus the current transaction, which will be this item. So we have the foreign currency receivable is going to be the debit, 300, same as we would see before, bringing the receivable to that 61,200, which is the 100,000 times the current rate, or the forward rate here of the 0.612. The other side, though, not going to the gain as we would normally expect it to go, but this time going to the other comprehensive income. That's due to the fact that the derivative is designed as a cash flow hedge at this point, right? It's a cash flow hedge, so that's going to be the difference. So we're going to be putting it to the other comprehensive income. Okay, and then we're going to say we have the next year happening. So the next relevant point is in the next year on January 30th, 2000x2. So January 30th, 2000x2. So we're going to be taking then our ending numbers here. That's going to be our beginning numbers here. So these are our beginning numbers. The equity section has now been closed out to the retained earnings, which I'm just going to put all the equity into retained earnings. So this is like our post-closing trial balance, or our beginning trial balance for then year 2. Nothing currently in the income statement accounts. So then we're going to say this is where the actual purchase took place. Now, when the actual purchase took place, we're going to revalue the receivable as of this point in time again. So we'll revalue the receivable. So I'm going to say, all right, let's do the same kind of process. I'm going to go back up to the last point. So we're back up into the last area so that I can compare it to where we were before, the 61,200. We're now at 331x2. We're going to be using the forward rate. So we're going to be saying the 100,000 times the forward rate of 0.605. That's going to give us the 60,500. We currently have 61,200 in it, minus the 61.2. That's going to give us the $700 difference, and that's going to basically be a loss. Why is it going to be a loss? Because it was $1 Australian dollar being 0.612 US dollars, now $1 Australian dollar to 0.605 US dollars, the less US dollars per the Australian dollars. The Australian dollar got weaker. We're getting paid in Australian dollars, so that's not good for us, right? That would be then a loss. So if we go down, then we're going to be putting the debit then into, instead of loss, we're going to be putting into the other comprehensive income again. So we're going to debit the other comprehensive income. The other side go into the foreign currency receivable from the exchange broker, adjusting this account just as we normally would. So that the debit is the thing that will be then different, the thing that will then change. It's then going down to the other comprehensive income and is included in this number down below. And the receivable is now at that 60,500, calculated as the 100,000 100,000 times the 0.605. So the 60,500. So then we're going to put the depreciable asset on the books. So remember that we're in year 2. This entries column includes everything up and including the journal entry that we are currently working on in the current year. So we're going to put the depreciable asset on the books at this point in time. So we're just going to do our normal process to do that. We're going to take the 100,000, and even though we have not yet paid for it, we're going to pay for it in the future. We're buying it on account, which means we're going to put it into a payable account. We are going to be using the spot rate. So we're not using the forward rate, even though we haven't paid for it yet, because that's what we use for the forward contract typically. We're going to put it on the books at the current rate that's the spot rate. Okay, so we're going to take the 100,000 times the spot rate on 330, which is 0.608, and that's going to be the 60,800. So we got the depreciable asset on the books at the 60,800. Other side going to the accounts payable. So we're going to debit the depreciable asset, it then going up. The other side then going to the accounts payable for that 60,800. That 60,800 in Australian dollars, representing the fact that we're actually going to pay 100,000, which is worth 60,800 in US dollars at this point in time. Next transaction, we're now going to the 331 here. So, and that is when we actually make the payment. So we're making the payment at this point in time. So we have everything up and including the current journal entries are included in the entries column on the right-hand side. We're going to be dealing first. Let's look at the receivable as we've seen in the past related to the forward contract. So to do that, I'm going to go back up to where it was before this transaction. I'm going to go back up to the last one. Here's where our receivable is. We're at the 60,500. Let's do our calculation now for the current time period. We're going to take the 100,000. Usually we use the forward rate. We're not using the forward rate this time. We're going to use the spot rate. Why? Because it is this point in time. We're not looking forward to 331x2 because it is 331x2, and therefore all we have is the spot rate. So we're going to take the 100,000 times the 0.602. That's going to be the 60,200. What's currently on the books is the 60,500. If we subtract that out minus the 6,500, we get the $300 difference. That $300 difference is going to be a loss. Why? Because we had before 0.60, 1 Australian dollars is 0.605 US dollars. Now 1 Australian dollars is 0.602 US dollars. The Australian dollar got weaker because it's worth less US dollars. And this is a receivable, meaning we're going to get paid in the Australian dollars, and now they're worth less than they were before. So that's going to be a loss to us. However, instead of debiting the loss account for the foreign currency loss, we are now debiting the other comprehensive income due to the fact that the derivative was designed as a cash flow hedge. So we're going to be debiting the other comprehensive income. The other side going to the foreign currency receivable from exchange broker as it normally would. It's going to be included in here to bring that amount to the 60,200. That's 60,200 once again being the 100,000 times the 0.602. Okay, so then we're going to go to the next transaction, and we're going to revalue now the payable. So now we're looking at the payable. We're going to revalue the payable as of the current point in time when the payment's going to be made on 331x2. To do that, let's go back up top and see what the payable was before we entered this transaction. So here it is. Here, we're going to revalue the payable, which is going to be a similar calculation. We're going to say the 100,000 times the current spot rate, which is 0.602. That's going to be the 60,200 minus what's currently in there, which is the 60,800. That means we have a $600 difference. $600 difference is going to result in a gain. Why? Because we had before 1 Australian dollar was worth 0.608 US dollars. Now 1 Australian dollar is worth 0.602 US dollars. The Australian dollar got weaker, and now we're talking about a receivable. We're going to get paid in Australian dollars, and now they're worth less. So that would be basically a loss. Notice that 600 can also be calculated as 0.608 minus 0.602 times the 100,000, and that would be the 600 as well. Okay, so then we're going to be debiting the 100,000. I don't know why I just drew a line right there. I thought I was okay. So we're going to be debiting the accounts payable for the 100,000, and then we're going to be crediting the foreign currency transaction gain. So I'm going to put it into the gain, but then we're going to take it out of the gain and put it into the other comprehensive income shortly. So we'll record a loss shortly to net it out in essence. So we're going to say, all right, we're going to debit the accounts payable. That brings the accounts payable to that 60,200, which of course is the 100,000 times the 0.602. And then the other side going to the gain, increasing the gain. Next transaction is that because this is a derivative designed as a cash flow hedge, we're going to be removing, in essence, the gain or recording a loss against it, recording a loss for the 600 and then recording other comprehensive gain, in essence, moving that amount down to basically the other comprehensive component on the income statement. So now we're going to move it into the other comprehensive income in essence. So we've netted out, you can see the foreign currency gains and losses netting out that difference, or the difference being now in other comprehensive income. Next transaction is that we're going to pay off our forward contract. So you'll recall the forward contract was on the books at the 60,900 forward contract here. And it went on the books way back when we first put the forward contract on the books, which was the 100,000 times the 0.609. Hasn't changed since that time because it's in US dollars. There was no currency effect on it. It's just sitting there. Now it's basically due because now it's the due date 120 days later. So we're just going to pay it off. We're going to credit cash, paying straight dollar cash, and then we're going to debit the dollar payable to the exchange broker, reducing that liability down to zero and reducing the cash. Okay, next transaction we're going to have is that we're going to do the other side of the foreign contract, which means we're going to receive on the receivable. So we had a receivable on the books, the foreign let's look up here to see it. We had the foreign currency receivable, 60,200, because it's now revalued to the current point. That's 60,200 representing the 100,000 Australian dollars we're going to get, right? So now we're going to get the 100,000 Australian dollars. We're going to record that at the 60,200 because that's what the current exchange rate is, and we're going to record that stuff that we got, the stuff being currency. It happens to be Australian currency valued in US dollars, that value being 60,200. The credit then going to the foreign currency receivable from the exchange broker, and that's going to be the 60,200. So now we've got this asset on the books, which again represents 100,000 Australian dollars, which we valued in terms of the current exchange rate, the current spot rate, to a $60,200 equivalent. And then the foreign currency receivable has now gone down to zero. So now we have the foreign currency units on the books, and we have our payable on the books, and we can go ahead and pay that off now. So now we're going to be debiting the accounts payable in the Australian dollars and crediting the foreign currency units. That will be reducing the foreign currency units down to zero. That's what we're going to use to pay off the payable, which then will go down to zero as well. Remember that these amounts we're paying actually 100,000 Australian dollars. And when we record that, just like we would if we paid with some other type of asset like equipment or something, we would record it the dollar amount, right? We have $60,200 worth of Australian dollars. We have $60,000 worth of Australian dollars, which happens to be 100,000 Australian dollars that we paid, and we're reflecting it being reduced on our books with our measuring tool US dollars. So at the end of the day, the cash is is here. The foreign currency units have now gone down to zero because we used them to pay off the payable. The foreign currency receivable from the broker is now down to zero. The depreciable asset is on the books at the 60,800. So it's basically simply on the books at the point in time that we actually purchased it at this point, right? We didn't adjust it for like the currency differences. We just simply took the 100,000 and we multiplied that times the point in time that we actually received it for the spot rate, which was, when did we actually receive it? On January 31st, 0.608. That spot rate. So we put it on there at the 60,800. We didn't change anything. What we did is we took the differences in the foreign exchange rates and recorded gains or losses, but in essence put them down into the other comprehensive income. So we're recording them in essence in other comprehensive income. Reflected here, gains and losses, we netted them out and basically recorded them in the other comprehensive income. So the accounts payable then down to zero at this point. The dollars payable to the exchange broker has now been closed out. We didn't use the firm commitment here. And then again, on the income statement, one of the major components you want to consider is the use or how that other comprehensive income was used due to the fact that the derivative is designed as a cash flow hedge.